Hey there, and welcome. Let's talk about something you probably have tucked away in a file cabinet somewhere, your life insurance policy. If that policy is more than 10 years old, you might be sitting on a financial tool that's, well, seriously out of date. Today, we're going to dive into how you can give it a major upgrade and do it completely tax-free.
So let me ask you, is your policy really working as hard for you as it could be? Think about it. Interest rates are the highest they've been in over 15 years. A lot of those older policies were built for a totally different financial world, and they just can't keep up with the features and the returns that are possible today.
And we're not talking about small potatoes here. Look at this number, nearly $93,000. That was the average value of an insurance policy transfer recently. It just goes to show you how much real potential value is sitting there, locked up inside these older contracts.
All right, so let's get right into it. What's the actual problem with these older policies? And more importantly, what could you be missing out on?
You see, a lot of policies that were bought back when interest rates were scraping the floor, say from 2010 to 2020, are often just kind of clunky. They're bogged down by lower returns and, frankly, higher internal costs. And maybe even worse, they're usually missing all the modern living benefits, like options to help you pay for long-term or chronic illness care. But here's the really good news. There's a powerful, though kind of little-known solution that's built right into the tax code. It's called the 1035 exchange. So what on earth is that? Well, think of it like this. It's like trading in your old car for a brand new one. Section 1035 lets you take all the value you've built up in your old policy and roll it directly into a shiny new one. And the best part? Not one penny in taxes on any of the gains. You're just getting a better vehicle. And hey, don't think this is some new sketchy loophole. This rule has been on the books since 1954. Its purpose from day one, and you can see it right here in the official report, was to help people get a policy that was, and I quote, better suited to their needs without getting smacked by a big tax bill. It's designed to help you.
Okay, now for the fun part. What does this upgrade actually look like in the real world? Well, the improvements can be absolutely dramatic. We're talking way more coverage, awesome new features, and sometimes you might even pay less.
Check this out. This is a real-world case of a married couple. Using a 1035 exchange, they took their old $4.6 million death benefit and turned it into a $10 million death benefit. And get this, they did it all while keeping their premium payments exactly the same. That is more than double the protection for their family.
You think that's impressive? It gets even better. 475%. That's the increase in the death benefit that a 32-year-old client got when she exchanged her old policy. Again, with zero additional premium. That is just a massive, massive upgrade. But you know, it isn't just about that big death benefit number. Old policies were pretty one-dimensional. You pass away, they pay out. But modern policies are like Swiss Army knives. They are packed with features you can use while you're alive, like helping to cover long-term care or chronic illness. Plus, they often have much more flexible premiums. It's a whole new ballgame.
Now, this all sounds great, but you know there have to be rules, right? It's the IRS we're talking about. To keep this whole thing tax-free, you have to follow their requirements to the letter. So let's break them down.
The good news is the process itself is pretty straightforward. First, you analyze what you've got. Second, you apply for the new, better policy. And third, and this is absolutely key, the insurance companies have to transfer the money directly between themselves. And thanks to everything being digital now, this whole process usually only takes about 21 to 30 days. So here are the non-negotiables to avoid taxes. The owner and the insured person have to be the same on both policies. The money, as we said, has to move directly from one company to the other. It has to be a like-kind exchange, so life insurance for life insurance. And finally, this is a big one. You absolutely cannot take any cash out for yourself. Any money you receive is taxable. And here is a vital piece of advice. Please do not cancel your old policy. You keep it in force through the entire process. The new company handles all the paperwork to close out the old one once your new coverage is officially issued. This way, you are guaranteed to have absolutely no gap in your coverage. Now, I want to be really clear here. An exchange isn't the right move for everyone.
So it's super important to know the red flags that might signal you should probably just stick with what you have.
For instance, if your health has gotten significantly worse, a new policy could be much more expensive, or you might not even qualify. Also, you gotta watch out for high surrender charges on your current policy that could wipe out any benefit of switching. And you know what? If the new policy is only a tiny bit better, it's often just not worth the hassle.
So, with all this information, how in the world do you decide if an exchange is the right move for your specific situation?
Ultimately, it really just comes down to the numbers. This has to be a data-driven decision, not an emotional one. You need a clear side-by-side comparison. The benefits, whether it's a higher death benefit, lower costs, or cool new features, they have to clearly outweigh any fees or downsides. The math has to make sense.
And so that leaves us with one last question for you to think about. Given all the changes in the market and the incredible innovations in what policies can do now, isn't it time to pull your old policy out of the drawer and just see if it's still the best tool for the job?